Yesterday, Friday, January 9th, President Donald Trump met with a number of oil executives to talk about going into Venezuela and restoring Venezuelan oil production. Now, I'm going to talk to energy economist Ed Hurst from the University of Houston. He, before the meeting, the day before, he had an editorial published in the Houston Chronicle about this meeting, and I'm going to talk to him about that and what came out of the meeting. So, welcome to the interview, Ed.
Thank you, Mark.
Describe for us in general terms what you argued in the editorial.
Well, the economics really don't work right now in Venezuela. As we've seen from Rystad Energy and Wood Mackenzie, they estimate a break even of about $80 a barrel to get the Venezuelan crude produced to market. Um, the current WTI price is less than $60 a barrel, and Venezuelan crude trades at a discount to WTI. So the math just doesn't work. And as Darren Woods, the CEO of ExxonMobil, said, Venezuela is not investable at this time. It's important to realize it's just not the money. It appears that the Trump administration kind of views this, and we're just 1 week into this new situation in Venezuela as a takeover, kind of like in Wall Street. And they can waltz in and put a new CEO in place and go forward. That's not the way this is going to work. More than 90% of Venezuela lives in poverty. The oil production is protected by the Venezuelan army, yes, but as Wood said, as many of the CEOs said, we have to make sure that our teams are safe when they go in to evaluate the situation. Personal safety, extremely important. As Woods pointed out, ExxonMobil had been expropriated twice in Venezuela. When President Trump asked Halliburton about going in, the CEO said, "Sure, we'd be interested. We haven't been there since we were um, uh, tossed out in 2019." And Trump intimated, "Well, that was under a prior president." Well, actually, that was under Trump. And so uh, there are a lot of disconnections here that haven't been fully thought through. Secretary of State Rubio talked a bit about that. Going in and making sure the population is taken care of. This is a country with limited food resources for some reason. Talking about distributing the wealth, if you will, the money from the sale of the oil that the U.S. is taking possession of on the oceans. Uh, how is that going to work? Is the population just going to receive checks from the Treasury? Are you replacing one form of socialism with another? There are a lot of moving parts to this, and oil fundamentally is the economic engine for Venezuela. But a lot of things have to be addressed before that can be put into gear.
Yeah, we've heard all the stories about how the oil and gas infrastructure in Venezuela has been allowed to deteriorate over the years, and really probably can't be repaired. Most of it will have to be replaced. Tens of billions of dollars, multiple years to get it up and running. And one of the things that came out of the meeting, and I know you sat through it, so I'd like to get your comment on this. Chevron promised that within 24 months it could raise its production by 50%. So it's the only U.S. major in there at the moment. But it only produces 200,000 barrels. So an extra 100,000 barrels is not really a big contribution to global heavy crude markets. And Repsol, the Spanish company, said it could increase its production by 3 times, but it'll only make 70,000 barrels. So we're only
That's right.
talking about an extra 140,000. So we keep, there's this the whole story seems to be driven more by hype and narrative than by actual economics and data.
Yeah, that's it exactly, and that was a hallmark of the first Trump administration, and is certainly a hallmark of the current Trump administration.
Well, is it fair to say then that it's more than likely that in the short to medium term, maybe, that really the status quo will prevail in Venezuela and probably in American oil markets. And the only one that matters for Venezuelan heavy crude is the U.S. Gulf Coast. You live in Houston. What's the take?
That's what it has to be. I mean, this is not going down to Venezuela and opening a spigot and lining tankers up and shipping it someplace and getting the benefit of cheap oil. 99% of the West Texas producers are really going to be very upset if they find their own tax dollars going to subsidize essentially a new competitor in the global market. That's not going to fly. They won't be lining up behind Democratic candidates in the midterm elections. Um, the math has to work for this to be an economic venture. Are there other reasons for having removed Maduro? Yes, of course, but oil is not the primary reason, and indeed the industry understands that by going into Venezuela and making it another large producer again, which certainly they could be, it's going to take tens of billions of dollars, more than 100, more than 180 in one estimate, to restore Venezuela to be able to export 2 million barrels a day.
Here's something I want you to comment because this that hasn't I don't think it's been talked about at all, and that is the industry has been moving away from long cycle investments. And the example of a long cycle investment would be the Alberta oil sands, where the resource is going to last 30, 40, maybe even 50 years, as opposed to short cycle investments like the American shale industry, where you produce a lot right at the beginning, and then after 2 or 3 years, you have to go and drill another well. But that means investors get their money back in 2 or 3 years. And so the industry is favoring, and has for a while, short cycle. But Venezuela is the very definition of a long cycle investment. And that seems to go against the grain.
Well, and in fact, you're assuming some facts that aren't in evidence. It's not all of the investors in the shale plays have made money, and the great challenge for the U.S. oil patch is it is the worst performing sector in the S&P 500 over the last 12, 15 years. Now, sure, the stocks all jumped up this week, but that was kind of like a Reddit bubble. The issue is, can they make a rate of return? Can they make a return on capital? And by making this delineation, if you will, short cycle, long cycle, are we talking about a return on capital? You know, ExxonMobil wants a return on capital. Some of the guys in that meeting are just looking at marginal cost issues. And so if the capital is already in place, if it is just a matter of going in and recompleting wells, replacing a couple of sections of pipe, that's it because the capital equipment, it's a sunk cost. And that's what we're seeing across the US and especially out in West Texas right now. Their break even for drilling new wells is somewhere around $70 a barrel. Sure, they're still producing at $58 a barrel, but that's because they drilled the well last year and the year before. It doesn't pay them to shut it in. And so we're going to see this cycle, and that's exactly what it is, play out over time. If for some reason OPEC Plus wants to restrict production again, or there's a serious dislocation with one supplier, Russia, for example, Iran, for example, then we'll see the global oil price jump. Anything over $100 a barrel brings Venezuela into play, makes everybody in the U.S., puts everybody in the money, as it were. Really makes the LNG market look good too. But counting on war and severe dislocations due to some sort of physical embargo or military action, that's not a good long-term strategy, and Wall Street won't let you invest on that basis.
Well, let's talk about this issue of marginal cost of production, because if I understand you correctly, Ed, you're talking about the cost of getting a barrel of Venezuelan oil out of the ground would be X, and a much lower X if the existing infrastructure can be patched together and made to work, and it can be brought to production fairly quickly. But
Right.
if you have to go in and make all of those you have to replace that infrastructure. You have to bring in new, you have to build new pipelines, and you have to re-drill wells or drill brand new wells is probably more likely. Then all of that then is a full cycle cost, and it's not the marginal cost, and that then makes it much less attractive for the big oil companies. Have I got that right?
Absolutely right. Yeah, with the U.S. shale plays, and I was part of one of the companies that developed the Denver-Julesburg Basin. Um, your economics are vastly different if you're leasing acreage at less than $15 an acre versus leasing it at $55,000 an acre. The Venezuelan crude is known. It's not an exploration project, it's a development project. And so that that full cycle cost um, that the consultancies are looking at, that doesn't include any exploration risk. Um, and so it's a very, very different economic engine, if you will, for Venezuela and the analysis. And it's the same pretty much with the Canadian tar sands. We know where it is. It's right there. We can scrape it out of the ground. And indeed, in Venezuela, there's an asphalt lake. The trucks drive out onto it, scrape up some of the asphalt, put it in the truck, and then take it off to a heated tanker that then transports it.
Let's talk about the Canadian break-even cost for a moment, because you mentioned Rystad and Wood Mackenzie studies, and they peg Canadian costs at $55 a barrel when Venezuela's at 80. But in fact, we saw just last year, about June, I think it was, S&P Global, another big international company, came out with a report on Canadian oil sands break-evens, and they are not at full cycle. They're now their upfront capital is paid off, and they are now running on what they call half cycle, and their half cycle costs are like an average of $27 a barrel, and as low as 18 apparently. And it just seems to me that if Venezuelan oil has to compete at full cycle, $80, versus Canadian oil, which is half cycle, $27, the economics are to me, appear fairly obvious.
Absolutely, pretty straightforward. Keep in mind it's global market, and that Venezuelan crude doesn't have to come to the U.S. A lot of it's been going to China. Some of it's been going to Cuba. Russia will just divert some of its cargoes straight to Cuba. Uh, it's a global market. Losing Venezuela, would that have an impact? Absolutely, but it's vastly overstated right now.
That's another question I want to ask you about, Ed, because I saw an energy economist a couple of days ago comment, and he said, look, let's assume that the American government redirects the Venezuelan oil from China, and it's about 400 to 500,000 barrels a day of heavy crude that goes to China. So take it from China, direct it over to the U.S. Gulf Coast. Well, whatever is not competitive will be cleared by the market. That is, it'll be re-exported to other markets where it'll be resold at maybe at a lower cost, because price is everything here. But it's not like Venezuelan oil is somehow going to displace Canadian oil, and then it'll get backed up in pipelines and cause a problem for Canadians. It'll just get re-exported from the U.S. Gulf Coast. And I should mention already at least 700, a couple 100,000 barrels a day of Canadian heavy gets re-exported. I mean, this is just
Uh,
how the market works there, right?
that's absolutely true. And keep in mind that when the U.S. was running down the SPR during the Strategic Petroleum Reserve, during the Russian invasion of Ukraine, a lot of that oil was exported. This upset a number of folks in the Congress, and even in the administration. But the fact is, it's a global market, and the U.S. has roughly a 50-50 mix, if you will, of heavy crude and lighter crudes in the Strategic Petroleum Reserve, along with some refined products. And so, once that tanker's loaded and bids are accepted for the sale of that oil, it goes where the market wants it to. And two of the groups there yesterday were Vital and Trafigura. They're both oil traders. And, they will handle the sale of that oil into the global market. Well, that's one thing the Department of Energy does do. It runs a marketing operation, both purchasing and selling oil. So this is straightforward. One barrel going into the global market is essentially the same as another.
So let me paint a scenario for you here, Ed, to see if this is plausible. So let's assume for a moment the Trump administration redirects the Venezuelan oil into the U.S. Gulf Coast. It can't compete because it's too high cost. And the traders that you just mentioned then simply trade it back to China where it was originally going to go at it, and maybe just at a lower cost because they have to make a margin on it, and maybe the given the circumstances, China gets a lower price, whatever. But the point is that it could still wind those 400,000 or 500,000 barrels a day could potentially wind up back in China where they were originally intended to go, just simply with a little detour.
It's entirely possible. And what is more likely to happen, though, is that the Venezuelan oil would displace the Saudi heavy that the U.S. imports. The Saudis would then turn that tanker over to China. Um, Transport costs at that point actually become important. Um, and the U.S., I think, brings in about 4 million barrels a day of Canadian crude. A lot of that is processed through the midsection of the nation. I think 1.5, 1.6 actually makes it to the Gulf Coast. Um, having Venezuelan crude come in, supplants it, doesn't necessarily displace it. There will be a bidding war, but it won't be that substantial across the global market.
Yeah, this idea that there are no other suppliers in the world of heavy crude. So let's draw a little context for our audience here, Ed. According to S&P Global and their recent reports, the global heavy crude oil market is about 10 million barrels a day. 5 million barrels a day of refining capacity is in the United States. So that's 50% of all heavy crude is headed into the United States. The other 50%, China takes about 25% of that. So it takes about 2.5 million barrels, or 25% of the total. And then India takes another 1.5 million barrels, and the rest is distributed amongst Europe and Korea and Japan and a few other little small customers. So if Saudi Arabia, which has $2 a barrel transport cost to China, and also to India, if they get frozen out of or outbid in the U.S. Gulf Coast, as you say, they'll just turn around and sell it to China, where they've got low transportation costs to begin with, right?
Exactly. And keep in mind, the Saudis have been building more refineries, expanding refineries. They're going to go ahead and try and capture some of the profits that are available downstream.
Yes, and that's a very good point. As I was reading the other day from Reuters or Bloomberg, that they're building these same crude to chemical complexes that China is building, and they currently have about 1 million barrels a day capacity, and it's going to be as much as three, perhaps, by the mid 2030s. So they might just do more processing at home.
Yeah, that's it exactly. Venezuela had that capability decades ago, and a lot of the exports were refined products. And of course, refineries have this challenge. They're not making money on the exploration and development, and so refineries make returns in the pennies per barrel. Um, yeah, the president yesterday in the press conference talked about, refiners going down. Valero was there. Marathon refining was there. They're not really that anxious to run down there. Now, Marathon and Valero both have refineries along the Texas Gulf Coast that can process the Canadian crude and the Venezuelan crude. You know, if they can make an extra couple of pennies a barrel, they'll do it.
Okay, so I mean, we've talked a lot about a lot of issues here, and my takeaway, Ed, is that this is a very, very complex issue. It's a big onion with a lot of layers on it, and it's difficult at this point to predict exactly which way it will go. And of course, the Trump administration is a big X variable because it could come in with laws, it could come in with subsidies or some other financial support to make things happen. So we really don't know. And I guess my point is, I'll have you comment on this. The Canadians shouldn't panic. And probably the oil companies are not panicking. The Canadian oil companies are not panicking. They understand their competitiveness in this particular market. It seems to be everybody else that's panicking. But really, this is a case of everybody should just calm down and we'll see how it sorts itself out.
The frenzy coming out of the administration and the literally the circus. It was a round table at the White House yesterday. Harold Hamm, CEO of Continental Resources, he's very straightforward. He said, this is going to take time to develop. Uh, Everybody said that, apart from the one or two private companies who said, "Oh, we're down there." One of them said, "Well, we operate in Kazakhstan and Libya. That Venezuela is not an issue." Those are truly, he may know what he's talking about. But ExxonMobil is going to be concerned. Chevron's going to be concerned, even though they are there. The exposure for them in the stock market is real. They have to husband their resources and their capital carefully. Um, ConocoPhillips, the CEO, was there. Well, he laid off 25% of his workforce this past year. Uh, sure, everybody's interested in the prospect, but it's going to take some time to wrap their arms around it. And I recall in 1989 in Houston, the Petroleum Equipment Suppliers Association hosted the CIA. We came down from Langley and did overhead projector slides. The young analysts were saying, "Well, we've never done a presentation to the public before." And in the hotel with 10 tables, there was one guy named Bob at every table. And they wanted to know from the oil service companies, when you go into Russia to see what the condition of the oil industry is, please let us know on the way out. And the Soviet Union had dropped dramatically in its oil production over the decades. Well, Russia welcomed everyone in, and then 10 years later took it all back. And so the guys running the big oil companies here in the U.S., they remember that. They were young employees at those days, and they take a long view of developing assets abroad.
Ed, I want to follow, just we'll conclude the interview this way, but I want to follow up just a bit on a comment you made earlier, which is that, the oil industry has not been very competitive as far as returns go with other sectors. And investors are putting a lot of pressure on oil companies to increase and provide the maximum returns back to shareholders as a consequence of that. So, what the message for me from that is that shareholders are not going to support any adventures in Venezuela that take a lot of capital for in a very risky environment. And so that the CEOs may say one thing at the table, but if they have public shareholders, those shareholders might not agree with them.
That's absolutely true. I mean, the outcome from yesterday's meeting was, anyone who's worked in the oil patch knew exactly what the outcome was going to be. The Chevron, Exxon, uh, the surprise might be Harold Hamm saying, "Hey, this is going to take some time to study. We're not rushing in there. Yeah, we'll send some teams in to evaluate it." And keep in mind, Venezuela's laws are such that PDVSA, the state oil company, has a 50% share or production sharing agreement, very much the same way all the OPEC nations do. Iran, Iraq, Kuwait, Saudi Arabia. These nations own their assets, and I think there's Again, a rather naive view that the Trump administration has just acquired Venezuela, like, one oil company would acquire another.
Yes, that's true. And of course, what they've done is they've taken out the head of state, and then they've supported the installation of the vice president, Delcy Rodriguez, I think is her name. And but the regime stays the same. All the laws stay the same. Everything else stays the same. It's just the
Oh,
head of state has changed.
like all the consolidations that are going on in the oil patch, because the price of oil is now less than $60 a barrel, you don't need two CEOs.
Fair enough, Ed. Thank you. This has been a very insightful interview. I really appreciate it. Thank you.
My pleasure.